Hey, everybody. Welcome to the morning market briefing. It's Thursday, January 29th, 2026. Hope you're doing well out there. Ben, how we feeling?
Doing all right.
Hanging in there?
Yeah.
We did have the Fed meeting yesterday. We'll jump in there. As expected, things staying steady. We did get a dissent from Waller, though. We're not necessarily shocked by that.
Yeah, I mean, Kalshi, the prediction markets weren't, and we talked about that yesterday. I was actually surprised when I saw that. I thought there was a big arbitrage opportunity actually in the betting markets. You could go long Waller on the idea that he might be the new Fed chair at 9 cents or 8 cents, and you could go short the fact that he would dissent at 72 cents. So the risk reward was favorable there. So even if you lost with the dissent, you doubled your money on him basically doubling in odds to be the new Fed chair. And I would actually have him higher than where he is now. I think it's 17%. Because I do think that as you think about the new Fed chair and the Trump administration right now, the administration appears to be trying to coalesce a little bit more and try not to rock the boat as much as they have. I feel like they've recognized that their base itself is fracturing. And I think you've seen this with Schumer and Trump talking about ways to get around not shutting the government down on Saturday. I think that's becoming less of a scenario versus the beginning of this week. There were a lot of headlines about that, but I don't think that's as likely anymore. And I think that you have the Waller dissent really feeding in. And right now, if you're Trump, it's the path of least resistance. He's already on the Fed. He'll probably get approval as chairman. He still has to go through a Senate confirmation for that, just as anyone would. But
he's there. He's in the room.
Exactly. So you've got that. Stephen Moran also dissented. That's not surprising.
He's there to dissent.
Yeah. Mickey Bowman did not dissent, which was viewed as hawkish because they say whoever is the new Fed chair will have some heavy lifting in order to get people on. It'll man his side to cut rates. So I disagree with that a little bit. I think Bowman will flip and turn tail. I think they were just kind of trying to coalesce on one thing. They knew they weren't going to cut rates.
Yeah, there's a little bit of there's a little bit of a human element in terms of a bunch of people in a room not trying to be that guy or that girl.
Yep. And I think that yesterday the headlines from the Fed were actually really thin. Nick Timrose had said that if they leave in the language that they will consider further adjustments to the Fed funds rate, that would be perceived as dovish. Well, they did leave that language in, but I think the only having two dissents more than offset that. So that's where we are. No change in interest rates. They will remain in a target range of 350 to 375. I do think that I would take the over of 1.8 interest rate cuts for the remainder of the year. I think Tom's a little bit less on board with that than I am, although I think his base case is about 2. But he's said before, and I think that his makes a fair point, that anything between 0 and 6 is plausible for the year. So we'll talk a little bit more about why I think that we could have more rate cuts this year. But again, a year's a long time, so we can also save that for another day. But really, no big headlines. He was asked a bunch of questions that he didn't really want to answer, whether that's being served or whether that was attending the Lisa Cook hearing. So it was one of the more boring, dull press conferences from the Fed, and that's saying a lot.
Yes, it really is. Lots of earnings to get to, but before we get there, we've had a bunch of questions lately on the topic of gold. For context, gold now at 55.53 an ounce. It's up another 4.5% today. It's just really run. Goldman set a new price target for it last week. It's already surpassed that. JP Morgan now has an analyst saying it could get to 8,500. When you're thinking about gold from an investment perspective, which in some ways is hard not to in this era, I mean, the number of commercials for gold buying and people out there, it's it's certainly in the moment right now. How do you approach positioning gold in a portfolio? What are the use cases of it?
Yeah, I think this is kind of coming down to the individual client and really an individual person, because I don't think that you need to be an investment client in order to own precious metals. And if you are an investment client, I don't think you need to necessarily own precious metals within your investment account that's managed. So there are two reasons to own, I'll just say gold in this instance. I think it also applies to silver, potentially to platinum. I know there's been a big push to include palladium as a precious metal. That's not happening. That's used in catalytic converters. I know about 15 years ago, they started trying to make jewelry out of palladium. It didn't really catch on.
No.
But so we'll just stick to gold. Everything else is kind of a derivative about that. But what I'm saying, most of it applies to gold. So 2 cases to own gold. The first case is as a speculation and a speculative vehicle. And the second is a store of value. In the first instance, as a speculative vehicle, it basically means that someone is going to pay more for that ounce of gold in the future than you paid for it. Just kind of like a lot of people trade Bitcoin. And the reason that you can have success in speculating in gold is, my view is it trades on the following. I believe that gold trends, number one, and it trends based on Fed policy. So if the next move from the Federal Reserve is to make monetary policy more dovish, then you'll want to buy gold and own gold. And if the next move from the Federal Reserve is to make monetary policy more hawkish, then you want to sell gold. This is a little bit different than what a lot of people think. A lot of people think that when you're at max dovishness, you want to buy gold. That's not correct, because if that was correct, when the Fed announced QE infinity in 2011, and when they were buying everything under the sun in 2020, you would have thought gold would outperform. But it didn't. In fact, it was flat to negative over both of those time periods until you reached a period of max hawkishness. And that means in 2022, when the Federal Reserve was raising rates incredibly aggressively, at that peak, at 5.5% on the federal funds rate, you would have actually benefited from owning gold, because at that point, Fed policy was too tight.
Yep.
So the next move had to be dovish.
Yeah, and for context, if you went to October of 2012 and you held gold, and you went all the way to October of 2022, you would be flat.
Yep.
At this point in late 2022, gold was at 1667. In late 2012, it was at 1717. So you actually be down just a little bit.
And I mean, and it goes both ways. I mean, even in 2018, you had that mini rate hiking cycle that first time. And then right after the Fed hiked that extra time, then gold started to outperform. So all of these things, this is how I think you can speculate on gold. I do not do this personally. I don't advise clients on doing this, but I think that would be how I would speculate on gold. Understand that it's a trend, and then think about what the next move of the Federal Reserve is. For example, right now, I think the next move is for the Federal Reserve to be more dovish, and gold is certainly trending that way. So if you put a gun to my head right now and you say, is gold going higher? I'd probably say yeah.
Yeah.
But I also understand that it can change quickly. You get a new Fed chair in there, cuts rates a few times. Now with their max dovish,
now the trajectory switches.
Exactly. The second reason to own gold, I think, and I think this is more accepted. I don't know if it's accepted more as an excuse to buy gold, and really it's speculation masquerading as this, but it's a store of value. So basically, for the last however many thousands of years, gold has been accepted as a form of payment and a store of value and a currency. And it still largely is today. I mean, a lot of central banks are backed by gold. Even the Federal Reserve has large gold holdings. So it's accepted as a store of value. And if you want to have a portion of your portfolio in that, almost as disaster insurance, if all your dollars vaporize or we have a mass technical outage and you lose access to all of your accounts, then having some gold might make sense as a portion of the portfolio. And the way I talk to people about this is just as you would have your monthly savings, the amount that you want to set aside every month, a portion of that, buy physical gold and put it in a safe, a bank deposit box, bury it in the backyard. Don't really tell anyone about it. This is your disaster protection, and it's supposed to be a store of value, and you probably don't even mark to market. The U.S. Treasury doesn't mark to market its gold. This is your disaster insurance. So those are the two reasons that I would own gold. I know it's a long answer, but we have been getting a lot of questions from clients over the last. I mean, it's ramped up a lot even in the last.
But
5
notably,
days.
you wouldn't buy gold just because it's up a lot right now.
I would not.
Yep. Let's talk about a couple themes before we jump into companies. The AI spending spree. We're still kind of seeing this balancing act between the revenue and the cost associated with these spends.
I mean, OpenAI, I think, is turning into the albatross. For those of you who are familiar with the rhyme of the Ancient Mariner, but it is the albatross around the necks of so many companies right now, and really the biggest companies. It is becoming an albatross for the likes of Oracle, a huge company, and now Microsoft. OpenAI is now 45% of Microsoft's backlog. Microsoft is spending $37 billion a quarter on CapEx and only generating $5 billion in free cash flow because they're spending so much money in CapEx. A lot of this capital is dedicated to OpenAI in the promise that there will be future revenue there. But in order for OpenAI to generate the revenue that makes sense for Microsoft, it's got to actually start making revenue so that it can pay Microsoft, and it's not there yet. And I think that's the biggest question for all of these this huge AI edifice.
Bundle.
Exactly. And the more you're tied to OpenAI, even more so than Anthropic, the more you're tied to OpenAI, the more the market is very concerned about you. And so that's why I think we have Microsoft down today. Meta, notably, not as tied to AI. Yep. They're actually spending even more aggressively than Microsoft as a percentage of their business.
But the stock's up 8%.
Because they're saying, look, we're going to use it for ad recommender systems. We're going to use it to personalize your news feeds. And by the way, we're accelerating revenue today. We're not waiting for OpenAI to pay us. We're accelerating revenue from 24% to 30% today. So I think that's the big thing on the theme on the AI, and that's why you've got Microsoft down, Meta up, and frankly even ServiceNow. They're more tied to a lot of these partnerships. I don't think ServiceNow should be down today. I think that it's just kind of trading on a lot of the declines in a lot of these software stocks like SAP and Microsoft, and ServiceNow is in that bucket. So you're seeing declines there, but in companies that are generating accelerating revenue like IBM or Meta, you're seeing really nice gains in the stocks.
We've talked a lot about employment this year and the trends that we expect. It does seem, and Ben, you posed kind of the question in our show notes, but really the question is out there that when you look at the combination of the advancements of AI with the announced layoffs that we've seen even the last couple weeks, it feels a lot like we've spent the last 20 years or so, maybe longer, training, frankly, our peer group, Ben, a generation of folks that are highly compensated, that have very specific skills that mattered an awful lot until very recently, who are now seeing their upper middle management roles or their software engineering roles kind of evaporate due to these trends.
It was always be a doctor, be a lawyer, be a finance person, and then it shortly, kind of toward the tail end of my high school career, it started to become a tech guy, understand how to program, and be a software engineer. Those were the careers that people wanted to pursue. They got MBAs for them. They went to medical school. They went to law school. And what you're beginning to see now is AI can do a lot of these things. I mean, let me just read you a couple quotes from the Meta conference call. He's saying, this is Zuckerberg talking, he's saying, we're starting to see projects that used to require big teams now be accomplished by a single very talented person. Since the beginning of 2025, we've seen a 30% increase in output per engineer. We're seeing even stronger gains with power users of AI coding tools, whose output has increased 80% year over year. We expect this growth to accelerate into the second half of the year. This is exactly what we're talking about. We have people who were, to use a Trump phrase, the hottest. I mean, this was the hottest profession to be in, was software engineer. And now if you're doing 80% more compared to the prior year, you're doing 2 for the price of 1.
Yep.
Which means that one person might get paid more, but a lot of that money is going to CapEx. It's going into building a lot of this technical infrastructure. It's going to profits. We're seeing improved profit margins at some of these companies, and it's going to, and it's not going to that incremental employee.
I talked to a friend who's a software engineer. This was maybe 2 or 3 months ago. So the reality is the pace of play has probably changed even since then. But he talked a lot about, some of the big projects that he worked on early in his career as an engineer, 2010 to 2015, and the size of the teams and the length of time spent developing something for whoever the end customer was. And he was somewhat facetious, but he was like, I could do that in my basement by myself in 3 weeks now. And this was a 2-year project with 28 people on it. And he kind of noted that even within his space, he didn't feel necessarily the pinch or the threat of layoff, but he was like, you've got to have real product expertise, kind of a human component above just here's what it is, and really understand your customers to actually add value as an engineer in this day and age.
And it was just kind of what Jensen Huang talked about in a very long form interview that he did, I think, with Joe Rogan. And he was basically saying, look, you need to understand what you do. If you're a doctor, what you do is not just providing diagnosis and prescribing things. What is that calling? If you're in finance and you're managing money, what you do is not about researching or making trades. It's more than that. We can get into more details, but it's if you're at threat in a lot of these industries, and some of these people, they say, well, I have all these skills. I mean, LinkedIn, you get to show off all your skills. They even have those tests. Those mean
Doesn't
so
matter.
much less.
Yeah.
And we've commoditized all that. So I think that's just something that we'll have to think about a lot in the next few years, because to your point, 3 months turn into 3 weeks. By the end of this year, that might be 3 days.
Yep. Yeah. You hit go and it's done.
Yep.
On the industrial side, what stands out to you?
Well, we've talked a lot about on this podcast about broadening out of the economy and some green shoots, but I'm not seeing that in the numbers today. If you look at Canadian Pacific, you look at Dow Chemical, I mean, the chemicals business is just terrible. Dow Chemical is laying off 4,600 employees, which doesn't sound like a whole lot in the context of millions of employees in the United States. They only employ about 35,000 employees. I mean, this
13%.
is they're closing off pretty much all of their higher cost assets in Europe. They cannot make the numbers work. This is a company that was raising prices by 40% during the pandemic because of all the home construction. What do you need when you build homes? You need paint. And so Dow performed well during that, but they just continue to be really, really bad. I'm curious to see what BASF over in Europe does as well. Some companies are able to hold in there okay. For example, Caterpillar is up 1% pre-market, but that's only because of their data center related business. The rest of their business is actually relatively moribund. United Rentals, they were hoping for a little bit better 2026, but saying, hey, it's going to be pretty much similar to 2025. Waste Management, which is a decent proxy for how much, if you're producing a lot of trash, the economy tends to be growing. There was a big, back in the day, it used to be such a harbinger for the U.S. economy. As GDP goes, so does waste management. Waste management only sees volumes if you back into the reversing out the headwind from last year's wildfires, seeing volumes of about 0.5% to 1%. So basically,
not at the Hall household. Trash is through the roof. We are between houses. We bought a house. We haven't moved to it yet. Man, I spend like 45 minutes a day taking trash out. I'm just absolutely abusing the dumpster here in Narwhal. It is tough.
Well, imagine this. This is a little bit
We
of a
need
tangent.
more halls.
This is a little bit of a tangent, but might also explain the economy of Switzerland. So if Tom is listening, he'll like to hear this one. I know he's a big fan of the Swiss. But when you throw away garbage, like assume it's like a little plastic grocery bag. You put that on the side of the road to get picked up. That costs you €5 or 5 francs.
That's crazy.
I mean, that's why they don't produce trash, but they also just make chocolates and pharmaceuticals and do banking.
I mean, that's the cool thing. We went to St. Lucia over the summer. The cool thing there is you put the trash out on the side of the road. Nobody picks it up. Doesn't cost you anything. So who's winning that race,
So it's a tough environment but we look at the big GDP number and we think the economy is just growing gangbusters and it's broadening out. And I think it's a little bit broader than it was, but I do think that interest rates are holding things back, just continuing to be at the margin. So it's tough, though, because you've got a portion of the economy that's grown so big. I mean, we talked about, for example, tariff revenue, annualizing at about $300 and $350 billion. You just add up the CapEx that Microsoft and Meta plan to spend this year, that'll be $300 billion. Yep. I mean, that is the size of this data center investment. And something that we talked about for months, about being cataclysmic, not just for the U.S. economy, but for the world economy in the form of tariffs. That is what 2 companies are spending in 1 year.
Just swallowed up. I mean,
on
it's
CapEx.
Insane. We're certainly, it's hard to look at data like that and say, we're getting a good broadening out.
Mm-hmm.
It's very hard to see that. Good stuff, Ben. As always, good analysis. We'll wrap it up there. We will be back tomorrow morning. Hope you guys have a great Thursday. Talk to you soon.